for us, it's about being part of a transition and looking for new businesses that we can go into which are more environmentally friendly. And then for those businesses that we are in, working out how we can be less CO2 intensive.
Now have financial products such as sustainability-linked loans, green loans, which is really about linking that ESG strategy and the financing strategy for a company.
The reality is, it's when prices are up, the projects are moving forward and capital is flowing in, and that's when the processes are going on. So you get caught up in it.
Overall, for projects that are seeking funding, we see a really good standard of ESG type recognition and work.
So hello everyone, and welcome to another one-to-one mining investment APAC online content session. Today, to speak on mine finance, we have Deborah Caudle, Managing Director and Regional Co-Head of Mining, Metals and Industries for Asia Pacific at Societe Generale. We have Kevin McElligott, Managing Director for Australia at Franco-Nevada. We have Stephen Motteram, Head of Corporate Development at Noble Group, and Peter Rozenauers, Portfolio Manager at Orion Resource Partners. So thanks everyone for taking part today in this panel.
Thanks, Amy.
So I guess to kick things off, let's talk about the current ESG climate that we seem to be in within the mining industry. So what does this kind of mean? What does the ESG environment mean when you're looking at companies to invest in? What do you expect to see from the companies that you or your investors are looking to get into? So, how does ESG kind of overhang all of your decision making? Who wants to kick us off with that discussion?
I'd be delighted to kick off, Amy.
Great.
I think the industry, mining is a very capital intensive industry, and it's really done a good job of listening to its investors over the last decade or so. I mean, it listened to its investors about capital efficiency and not building projects for the sake of it. And it's really done a good job, I think, of listening to the investment industry's requirements to conform to various ESG principles. There's a whole raft of principles out there which can be adhered to. But I think overall, for projects that are seeking funding, we see a really good standard of ESG type recognition and work. So that's a really, a positive step. Where I think the industry will morph to over time will be a recognition of how they can continue to work with ESG over the life of an asset. We've all heard about, scope 2 emissions, scope 3 emissions, and so on. And I think that, that commitment to look at continual improvement on ESG matters over the life of the asset will be important. And I think the industry could also do a much better job of broadcasting just what it's doing with ESG. It could publish annual compliance reports. It could do a whole variety of things. That would be, I think, helpful for investors overall.
Yeah, I think that's right, Peter. And as you say, we've certainly seen probably over the last 24 months, I think fairly rapid adoption by the mining companies as they've, made commitments on reducing emissions and moving towards carbon neutrality. So whether it's energy consumption, adding renewable energy into the mix, and then they will be moving further downstream with the scope 3 emissions and looking at circularity. As well. And, I think, as you said, Amy, in terms of, what does the ESG environment mean for the decisions that we make when we're looking at potential assets, it's probably fair to say that ESG has always been an element of what we look at. And we've been a signatory to the Equator Principles, for example, for a long time. But, really, ESG is at the forefront. So it's a gating issue on things. And, we've seen, obviously, incidents such as the Vale tailings dam failure. And, the good management of things like tailings is a hot topic for banks. as well as actually expanding the credit assessment to include looking at climate change risks and the impact that they could have on the credit profile of a client during the life of the transaction. So certainly it's an increasing area of focus whenever we're looking at new opportunities.
Amy, from a trading company's perspective, perhaps I can give a few insights also. I mean, we participate in supply chains from various parts of the globe, predominantly then selling into Asia. We're a signatory to various compacts, and we publish a sustainability report on our website. And what that report details is some specifics around what we're doing in certain parts of the supply chains that we deal in. A good example I'm involved in is our alumina smelter in Jamaica, where we've been monitoring our Scope 1 and Scope 2 emissions. We publish those, and we've been trying to mix the energy input mix into that alumina refinery away from sort of heavy fuel oil, which is obviously high CO2 emitting, into being a mixture of gas supplied power, solar for our buildings. So we're doing a number of projects there to try and diversify the energy mix to make the Scope 1 and Scope 2 emissions linked to the alumina that we then supply down to aluminium smelters to make that lower. And then ultimately for the smelters, that means that they then have greener aluminium to produce, and hopefully that then makes their products more marketable. Aside from greenhouse related issues, we're also involved in some of our tin supply chains in Rwanda, for example. And so the key thing there is monitoring the supply chains and the tin concentrates that we originate to make sure we're not getting involved in any conflict minerals and concentrates and issues like that you sometimes get in Africa. And then more broadly, a few years ago, we set up a group called Talaxis, which invests in rare earths upstream exploration development assets to sort of complement some of our other businesses, which are a little more, I guess, fossil fuel heavy. We're still a coal trader, for example. So for us, it's about being part of a transition and looking for new businesses that we can go into, which are more environmentally friendly. And then for those businesses that we are in, working out how we can be less CO2 intensive.
Yeah, look, I don't have much new to say here, other than to reiterate a few of the existing points. Certainly we've always had ESG items on our due diligence checklist for looking at investments. What's different, as Peter mentioned, it's coming from our investors now. The analysts and portfolio managers that we deal with, it's now on their checklist, so they're asking us questions. So it's sort of the interest has gone one level up. A few years ago, none of our investors or analysts were asking us about any of this stuff, but the last 12 months, it's prominent on their checklists. And also in terms of publishing information, some of the best reports on these mining companies are already public on specific mining projects are already publicly available. Environmental impact statements, very detailed, that are filed before any construction activity takes place. But companies don't put them on their websites. They don't put them on their stock exchange filings. But that information's there, and I've always looked at them anyway. And certainly, obviously, the big issues, the big headline stuff is tailings and carbon emissions, as Deb mentioned. But in terms of the impact, I guess sometimes we think that it's the remote projects you don't have to worry too much about, but because when you're near a populated area, that's when the social issues are more prominent, and you've got people more concerned about simple things like noise and dust and traffic. And then when you get to remote areas, probably the first project I looked at many years ago, there's always there's an endangered species of some sort, some form of flora and fauna that has to be protected and dealt with. And again, that's nothing new. Just to circle back, I think it's just that our investors are paying attention now.
And how much do you see kind of the implementation of these stricter standards on the availability or the quality of financing that's out there in the market?
I can't think of I can't think of an opportunity that we've looked at where there hasn't been an ESG report. I mean, there are, to put it simply, if there was no ESG, if you're not capable of diligencing various elements of ESG, then there's no funding available. I think we need to consider that. When is an ESG report most relevant? Well, we provide growth capital, construction finance, predominantly, and so that's generally after an extended period of time of exploration and various techno-economic studies and permitting and licensing and so on. The reports are available. If you have a junior exploration company, it's sort of understandable that they're not going to have a full-blown environmental impact statement. It's just kind of premature. But at the point of construction, the studies will have been done, and in pretty much in all jurisdictions, there's an environmental study that's required to get permits and licenses. And so really a lot of the work's done before we come in.
Yeah, I think if I just link it back though, also thinking about sort of the available pool of liquidity for financing of transactions and the role of ESG, and what Kevin and Peter were both saying in terms of getting those questions now coming from investors as well. And I think what we've certainly seen is an increase in the available liquidity around ESG related financings. And certainly, we now have financial products such as sustainability linked loans, green loans, which is really about linking that ESG strategy and the financing strategy for a company. And we're seeing that, those financing decisions are being sort of taken out of the Treasury team and to the board. Because it's becoming quite strategic for them. And if I look at, something like the sustainability linked loans, in Asia Pacific in 2018, there was 2.6 billion of loans. And by the end of 2020, in 2020, it was well over 10 billion of loans. And that's really on the back of, obviously those flows of people wanting to invest in ESG related financings. And that's something that, we've spent quite a bit of time here at SocGen looking at is how do we actually apply these sustainability linked loans and green loans to the mining sector, which, people may not traditionally think of as being, a very ESG green sector. But certainly that's, a financing tool that we have been successfully implementing for companies and really working with them to set themselves up in terms of their KPIs, their reporting, etc., to be able to tap into that pool of liquidity.
And so some of you brought up the kind of the energy transition and the topic of decarbonization, which is really kind of taking over industry discussions as well. And so, is more of the financing going towards these low carbon projects, mine sites? Kind of how do you assess the benefits and opportunities, I suppose, that come out of these types of financings? And are you seeing kind of a drop off in the financing available for projects and stuff that don't meet those types of criteria as being necessarily green or working towards decarbonization? Maybe, yes, go ahead.
Yeah, I was going to say, in the backdrop of a lack of exploration over the last 10 years, really by historic standards, there, in many base metals and industrial metals, there is a big supply and demand imbalance on just current usage of these products. And if you overlay the potential for the green economy to grow, Some demand and supply imbalance is going to be exacerbated even further. So when you're doing your kind of analysis, you can justify making these investments based upon current conditions, falling grades, mine lives diminishing over time, reserves not being replaced. So the adoption of the green, or let's call it the green economy, is only going to accelerate that. So it doesn't drive the economics. The green economy doesn't drive the economics, but it's certainly part of the upside case. And if you look at it metal by metal, you could say, okay, well, its contribution in lithium is going to be a lot more pronounced than it is in copper. But copper's a net beneficiary, and nickel is a bigger beneficiary given the size of its market. But lithium is probably the extreme, where 40 or 50% of lithium production over the next 10 years, the growth is coming out of batteries. Certainly not that case in copper. So I think it's more about when we're making investment decisions, it's great that demand growth is a little bit unknown, and if you've got the project with the right attributes, then it's got some good upside to it. Yeah, that's how we think about it.
I'd just comment, Amy, from the perspective of being a company that's still involved in coal, and your question about decarbonisation, and if you look at the capital that's been raised, at least on the ASX equity markets in the last 12 months, plenty of it's been for early to mid-stage projects, and some of the metals that Peter mentioned. Syra, the graphite company, is a great example of a company that is sort of in production but has managed to raise a lot of equity capital, oversubscribed share placement plans and things like that. On the flip side, and I know this firsthand over the last 6 months, going to the market and looking to raise equity for coal, particularly thermal coal, is almost an impossible mission, right? It's very, very difficult. And so availability of finance is still there a little bit on the equity markets. Coronado raised some financing for met coal. Canada, there's been some met coal money. But if you're trying to raise money for more traditional fossil fuel, particularly greenfield projects, it's extremely difficult from traditional sources.
And I think
just comment on the available.
Sorry, Kevin. Sorry, no.
I was going to say I'm a bad one for this question on availability of capital, because our specialty is precious metals, and capital has been so abundant the past year for gold or anything precious metal linked that it's hard to see any distinction on the in terms of would you call green investing or not in these projects. I would say maybe some projects might have a few more players involved in getting involved in the financing because they've got better credentials in that respect. But otherwise, geez, there's plenty of capital available for good projects.
I was going to say, Amy, I think the industry needs to do a better job of saying that, if the market wants to replace a unit of carbon energy with a unit of green energy, it's got to do a better job of articulating just what's required to create that one unit of green energy. It just doesn't do that very well. It's not cutting through there. Sure, it does with specialist equity investors, but with the overall retail sector and so on, I think that message could be reinforced far more rigorously than it is now.
Yeah, I think that's right. And when we look at decarbonisation, I think there's a lot of focus, obviously, on areas such as, renewable energy, and certainly we do a lot of financings in that space. But when we look at the role of metals and mining as part of the decarbonisation and the energy transition, I think one of the things that has been recognised, and there was a World Bank report which talks about minerals that are required for climate action. And the growing role of minerals and metals in a low carbon future. So we've seen these aspects recognised, but perhaps not broadly communicated, if you like. But certainly that role of many of the minerals that Peter was speaking about, and their necessity for the decarbonisation is quite clear. And for us, when we've looked at our strategy and repositioned the business in the middle of last year, and part of that was around broadening out our mandate to focus on moving downstream into supporting things such as gigafactories, so EV battery facilities. So some of these end users of the green minerals, if you like, to continue to support that energy transition. And I think that is something that we'll see more of. And it's not to say that we don't still do the traditional business, as Kevin says. There's strong liquidity for things such as gold. But I do think that there is that additional overlay now of, trying to see whether or not, even within those transactions, are there elements of incorporating whether or not it's more on the ESG side of things, KPIs, areas of improvement for companies as well, to continue that alignment of the business with, what is a lot of investors' expectations.
Absolutely. And so this year has been, 2020 was a difficult year for travel and operations on mine sites and stuff. And so switching gears a little bit, looking to invest in a mine site or a project involves a lot of due diligence on the investor's part. And so obviously that was difficult this year, not being able to travel and see mine sites and stuff. What have been the processes that you've used over 2020 and now into 2021? How is it affecting your investment decisions, not being able to actually go and see sites and assess it with your own eyes?
It's actually interesting. We have been able to go and visit sites. Maybe that speaks to the age of the people that work at Orion. I'm not really sure, but we've got some ancient people like me working there. So the chances are that someone in the team has been to that site sometime. But there are, and travel has been open in certain continents. Africa, at various times has been open. Europe's been open. The Americas have been open. So it's just Australia has been a difficult place at times to travel across the border. So we've been actually able to continue to deploy. We've had Orion people attend site, but there's also consultants who don't have lesser travel restrictions, or subject matter experts who are able to do that, to do that travel. So really, from a diligence point of view, we wouldn't compromise our investment process. I think that would be insane to do that. And we haven't had to do that. And really, over the last 12 months, we've been able to do some of the largest transactions that we've ever done in the company's history. So it's actually been, and we certainly enjoyed the COVID-related prices. So it's been an interesting, good 12 months.
Mm-hmm.
Amy, I'll comment from a divestment perspective. Obviously, there's the investment perspective when you want to go and kick the tires, so to speak. But if you're sitting on assets and you're looking to divest those and run a process, in some of the parts of the world that we're involved with, when you cast the net and try and get parties interested, it is harder, and it takes longer to get the parties that are more remote from that particular continent into the data rooms and into the process. So if you're trying to run a quick divestment process, it's problematic, and you tend to focus more on local parties that are already in country, or international parties with an existing local presence who understand the market and maybe understand the assets. If it's a distressed divestment and your timelines are short, obviously that can be a problem, because you've got less sort of players in the pool to affect a transaction, and perhaps players whose pockets aren't as deep as some of the international players that you'd love to get into the process. So that's one comment on the divestment side. And then for some of our existing transactions where we look to restructure and roll things over, as Peter said, you need to be prepared to get in country whichever way you can, because often your competitors will find a way, right? So being in a trading company, we have some pretty aggressive competitors. I won't mention their names, but they are willing to charter a plane to get somewhere, even if the commercial airlines aren't operating, and get in there and get in front of your customer, and before you know it, the deal you're looking to roll over is half as big as it was before. So it's still a competitive landscape, and people are out there prepared to do the hard yards.
You want to go, Deb?
I don't think I really have a lot to add to what both Stephen and Peter have said. I think that sort of does outline the approach that we've taken, and using local consultants, having a global team, people that have been around for quite some time, that they've probably visited assets in the past. But the important thing is always maintaining that we are undertaking that due diligence at the end of the day.
Yeah, like I said, we the same points here. We thought it would have a huge impact. Turns out we've gotten to know some new technical advisors around the world that we previously haven't dealt with. We're not dealing with the same team constantly on every project. So there's a bit more variety there. So it's been an opportunity for some people to establish new relationships. And certainly the travel's still occurring. Just there's a lot less of it. Instead of a whole bunch of people traveling out to a site at the beginning of a process, it's a much smaller group near the end of a process, and you can see who else is, and it's like I said, it's a smaller group. Who the serious who are getting serious at the final stages. Clarifies things a bit. So.
Absolutely. And so, as you've all kind of said, it's still, despite COVID, it's been a pretty good year for the industry. Where do you see opportunities coming up as we move forward, whether it's specific jurisdictions that you're looking at, or commodities, or kind of interesting projects that you want to talk about?
Yeah, no, I think the elevated prices in base metals is sort of opening up opportunities for people to address some of the balance sheet issues that they have. I mean, there's been, a tremendous amount of activity in gold and in mergers and acquisitions. It's been great. Hopefully that picks up in base metals now because of the elevated prices, and there's, capacity to fund additional investment and so on. In some of the sort of more exotic materials, battery related, those companies still need capital. I'm talking about some of the smaller markets, industrial materials, vanadium as a battery material, or PGMs as a battery material, etc. Those companies are continue to invest and need capital. It's just a smaller pool of capital that can be directed or find those sort of opportunities attractive. So there's plenty to do.
Yeah, and I think building on what Peter was saying, so from a bank sort of senior debt financing perspective, we always take a longer term view on prices, and we look through the cycle. But where it does make quite a bit of a difference is the equity market appetite and support for some of these projects, and that is quite often what's required to unlock a funding situation, is to have that balance of equity and debt that are available to projects.
Yeah, it's funny. It's a double-edged sword. On the one hand, we much prefer to invest in a project at a time when the commodity prices are down a bit. You always like to feel like you're buying at the bottom of the cycle, but the reality is it's when prices are up, the projects are moving forward and capital is flowing in, and that's when the processes are going on. So you get caught up in it. So let's just hope this isn't the top for commodities like nickel, for instance, right now, which is probably one of the hot ones.
I don't have too much to add in terms of the specific metals. What I would say in terms of some of the PE funds that I've seen raising money over the last 12 months, I think there's quite a lot of dry powder out there within some of the well-known private equity funds, and perhaps they haven't had a chance to deploy that on valuations that they like because the equity markets have been so hot and it's been easier for the juniors to raise money there. So I think through 21 and 22 we may see the equity markets cool a little bit in terms of the ease with which some of the juniors can raise money through that route. And I think the PE funds that have got some dry powder ready will probably do well. And it seems that at least from some of the funds that have raised money recently, they're getting quite long mandates to sort of deploy and recover returns, up to 12 years. So I think there's at least from the endowments that are putting money into the sector, there seems to be people taking a long-term view, and hopefully that'll support the next cycle.
And I guess to close us off, do any of our other panelists, following on from what Stephen was saying, does anyone else have kind of thoughts on the outlook for the market overall, liquidity available, capital available to the market as we move forward and hopefully out of the pandemic?
I think governments have done a pretty good job overall of keeping things going. I mean, you just look at Australia's announcement yesterday by the federal government to support critical materials downstream. There's an investment element there. There's a geopolitical element. It's all very, very welcome. The local institutions of CEFC and NAIF have really, I think, found their role in the capital structure and, to be a de-risking milestone to bring in private capital. So I think that in the environment where there's a lot of fiscal stimulus that's going to take place, those government kind of instruments are playing a really important role. Hopefully they'll continue to play an important role, which is good, and the private capital will flow.
I would say, purely in an Australian perspective, and just take a larger view rather than, but everything's lined up. It's commodity prices are good, interest rates are low, savings rates are high because so many people actually banked all that stimulus money that they got last year, and then what was the budget change about immediate write-off of any capital expenditure, 100% write-off with in the year of acquisition or investment for the next couple of years. It's really lined up to be heavy on capital expenditure and development and moving things forward, especially with Australian projects. If anything, the next thing we'll be hearing about is inflationary pressures and lack of skilled staff and stuff.
Yeah, I think that's already started to come through, particularly around the skilled staff and what that's meaning for the Western Australian mining sector. I think sort of reflecting on 2020 and in the first half, there was a pullback from a number of banks. Through that time frame, there was a lot of pressure on bank balance sheets as companies were drawing down on facilities, and there was a lot of liquidity that was being consumed. Through the second half of the year, we saw things normalize. And I expect that we'll start to see increasing appetite during 2021 coming back to the sector. Again, it certainly has recovered a long way, and I think we'll just see more of that even further through into the rest of the year.
Great, sounds positive. So, so thank you all very much for these insights on mine financing. I think we should be in tune for a pretty good year, and let's touch base again, I suppose, in another year from now and see kind of how things have shaped up. So thanks everyone for taking part on this panel discussion today. We hope to see everybody live and in person at an event soon, and thank you.
Thanks
so much, Amy.